Right, well, good evening, everyone. Welcome to tonight's workshop. Tonight we've got Phil Harrison, who is my property accountant from a company called Cobb and Murphy. I've asked Phil to come in today just to give everyone some tips and advice around tax when it comes to setting up companies and obviously property investing. With that, why don't we just dive straight into those slides then, because it'd be really interesting to know what you're going to be sharing with us today.
Yeah, so the first thing I wanted to talk about is something that we call Section 24 tax. This is an area that you will, if you've got investment property, you'll almost certainly know about. The reason I've used the word Section 24 tax is probably 2 or 3 years ago, a client came to me and said to me, can you advise me on the impact of Section 24 tax? And I looked at them, I thought, what's Section 24 tax? So obviously went straight off and looked at it. When I realised that what he was talking about, which is more commonly known to everyone, is where you have property investment. And about 4 or 5 years ago, I think it was George Osborne changed the rules so that you couldn't get a deduction for tax at higher rate on mortgage interest. So what it meant was that all of a sudden, a lot of property investors were paying substantially higher tax than they were previously. So I always call it Section 24 tax because I've never forgotten the fact that I had a client come in, a potential client, raise it with me, and I didn't actually know what he was referring to. But that's fundamentally what it is. So imagine a scenario where you've got you've got some kind of income, either employed or self-employed income. You earn £40,000-50,000 a year, and then you've got 3 or 4 residential properties, and those properties you're renting out, you make 20 grand's worth of rental income, you have 10 grand's worth of interest costs, and then you have 5 grand's worth of other costs. So you've then got a profit of 5,000. You pay your tax on your £5,000 worth of profit. So what the Section 24 tax says, well, it doesn't work like that anymore. You don't get any deduction at higher rate for the interest, so your taxable profit goes up from 5,000 to 15,000, and you pay tax then at higher rate. So you're paying possibly 40-45% tax on £15,000 worth of profit. You then deduct your interest, and you only get that at basic rate. So people were ending up potentially making little or no profit from their rental portfolios, and this has been brought in over the last 4 years. It's now in 100%. The next slide covers off the topic that you've just mentioned there, which we can go through relatively quickly, but it's all about to be limited or not limited, and the advantages and disadvantages. So I'll run through. Most people have got limited companies.
I think most people have. I think some people have got a combination of some stuff in their own name, and unlimited companies. I don't think there's really anyone in the academy that's got everything in their own name right now. I think everyone's got some sort of SPV set up for their purchases or future purchases.
Okay, so just a few points then on the overall limited company versus personal ownership. I think that my view is that the bigger the portfolio, the more it leans towards being a limited company structure. There's a number of reasons for that. There's obviously the differential in the tax rates, but also limited companies are very much more flexible because the shareholders, the owners of the business, are different from the operators of the business, which means that when you come to a property portfolio, in particular when the numbers are bigger, it's very easy to amend the ownership within a limited company, or to pass over wealth from different generations or between different people, because it's very easy to transfer and manipulate shares. You can just, it's preparation documents, whereas if the ownership is individual, you're into getting consent of lenders, you're into potentially having to change the registry. There's all kinds of different loopholes that you have to go through, and that's one of the reasons, as the portfolio gets bigger, that I believe a limited company is a much better structure. I think the other thing that I don't know whether anyone's got this structure, but it's quite common in limited companies with properties is using what we call alphabet shares. So alphabet shares are where, rather than just have 100 ordinary shares, you might have 100 with 30 A shares, 30 B shares, and 40 C shares. And the reason for doing that is that you can vote dividends to the different classes of shares, meaning you can allocate income in a much more flexible format than you can if they're not limited. The only downside of limited companies, or the main downside of limited companies, as you may well have already discovered, is that it's still more expensive to generally get mortgages in limited companies. So that is the main downside. So generally, the more ambitious you are in terms of building up your portfolio, the better you are within a limited company structure. I wanted to quickly talk about inheritance tax, because for the property investor, the inheritance tax is a big issue, because primarily, unlike a normal trading business, you don't get what's called business property relief for investment property, which means that the value of your property is going to go into a pot that's going to be subject to inheritance tax. And if that goes above 325 if you're a single person, or 650 if you're married, then you'll be paying 40%. So work all your life and then give nearly half of it to the tax man. That's the rule. Now, when people are building up a portfolio, they don't really think about that seriously. But when they start to get further into their lives, they will think about that, and that'll become more and more of an issue. And then when you get towards the latter part of your life, your retirement age, etc., it'll become your biggest issue in terms of taxation. So I just want to put that on the agenda, that you need to think about it sooner rather than later, because before you know it, with property, it will hit you. And just one thing for anyone who might already have that problem, there is a route that you can get £325,000 worth of property, which, if there's two of you, means 650, over to your children without any capital gains tax or without any inheritance tax. It involves using trusts.
Yeah, that's actually something that I've been thinking about with my properties and my kids. So yeah, it's something. You're right. As I've got older, it's something that I've just become more conscious of.
VAT. So generally, this comes back to the point that the lady was asking before. Generally, when you talk about having to register for VAT, rental income is exempt from VAT. It never goes towards any calculations when it comes to VAT. So if you're looking at your VATable turnover, it wouldn't include rental income. The only exception to that I can think of that might be relevant to people is if they're doing short lets. And if you're doing short lets, and that can be VATable, and if their income goes above the VAT threshold, which is 85,000, then you do need to consider it VAT. But generally, you don't. It's not an issue. But the downside of that means that, of course, all that expenditure that you incur, you can't claim back the VAT. So there's an opportunity there in certain circumstances to claim back VAT that people might not have realised they could claim back. Now, where we get a little bit clever with these things is sometimes we've got investors that are buying to keep the property. We set up a group structure. One company buys them, converts them, and sells it to the other one, and that allows them to claim back the VAT. So we've used that a lot. We've done that a lot, and It's not worth doing if you've got a 20 grand refurbishment. But if you've got 50, 100, 150 grand refurbishment, even more, there's considerable savings to be achieved. The way the LLP went, we just have to go back in history a little bit. So the revenue have never traditionally regarded a property business as being a business. They've always said it's not a business. It's just investors. You're just investing your money for a long-term gain. There's a relief that's available for people who incorporate a business, and that relief is called holdover relief. And if you can claim holdover relief on a business, you can effectively transfer a business into a company without stamp duty or capital gains tax. This was always touted as a way you can get a big property portfolio into a company by what I call aggressive tax planners. But your traditional accountants would never really look at that, because the risk is you do it and you actually get it wrong. You've got a massive bill on your table that you might not have had. So what happened is that about 4 or 5 years ago, the revenue challenged somebody who'd done this, and the revenue have had a number of high-profile wins, because judges seem to have been favouring them the last few years in terms of tax planning. But they actually lost this case. They lost it in the lower tribunal, and it never went to the upper tribunal, which means that it's never been written in law. But the reason the revenue don't want to take it to the upper tribunal is they're not confident that they would win it on an appeal. So there's been a number of people with portfolios that have moved them into the companies, and the savings are substantial because it does two things. The first thing is it moves all the rental income to being taxed at not at higher rate. But the second thing is it rebases the cost of the properties, because they go in at their value. So if this portfolio has a big gain in it, you can potentially uplift the value to the current value. Then when you sell them, you don't pay any tax. So there's a real potential saving for people with big pregnant gains in their portfolios. That's the real positive bit. The difficulty is all around debt, and particularly if you've got debt in your partnership or your sole names, you've got to have lenders on board with this, and it's not always easy to do that. Particularly over the last few years, the marketplace with lenders hasn't been that great for portfolios. So we always would look at a portfolio and look at the lending book that's on there to advise someone and get them to discuss early doors with the lenders whether this is a feasible option. But there's potentially for bigger portfolios, there's potentially hundreds of thousands, if not millions of pounds worth of gains that can be sheltered in a limited company there.
Sounds really exciting, because we're looking at a number of portfolios that are being offloaded right now by the landlords, and I think the main reason is going to be tax. It's going to be tax. They're either stuck, they haven't evolved and gone to the right structure, so it's not a limited company, and of course they want to offload. So if there's a way of acquiring a portfolio, I mean, if it takes 3 years, it takes 3 years. But if there's a way of doing it where we can acquire a portfolio and then transfer it across into our company or whatever, that's definitely something really exciting.
Yeah. Okay. Well, that's something. It's one of those ones you have to look at the portfolio first, and just in terms of cost, values, income, etc., and you can decide then whether you think there's a route in. I'd probably say out of the every 5 I've looked at, probably 3 are a no and 2 are a yes. It's more no's than yeses, but the yeses are making big savings. The next thing I was going to talk about, which could also fit in with this, which is stamp duty related. So I don't know if anyone's come across what's called multiple dwellings relief. So this is when you buy a portfolio of residential properties. There's a special method to calculate the stamp duty. So you've got 10 properties, £2 million worth of property. So they're 200 grand each. What you do is you to claim the multiple dwellings relief, you work out the average price, and you pay the stamp based on the average price of each property. So that's potentially a tax saving, just looking at the kind of raw value of the overall property.
Phil, thank you so much for imparting your wisdom and your knowledge. You've given me some food for thought. I'll be getting in touch with you because we've got some portfolios in the pipeline. So excited to discuss that with you. Enjoy the rest of the evening. Have a great week, and I'll catch up with you all soon. If you're looking to get started in property investing, or you've already started that journey, but you've kind of stalled along the way and hit a plateau, but deep down inside, you know this is something you can and you should do, then check out the Reaching Excellence Academy. In there, you'll find not only the latest proven and tested strategies that are working today, you'll find mindset, peak performance, and the best direct-to-vendor marketing tools and negotiation tools. You'll also find a community of like-minded investors who are there to help and support each other, together with accountability and support from me, so that you reach your property, business, and life goals. Now, whether you want to invest in property to have a nicer house, a nicer car, or whatever, or maybe you want to have more financial security for you and your loved ones, or perhaps you just want to have fun and live your best life. If that's the case, then this is for you. Now, to find out how you can put this to work, click the link on your screen now or in the description below and book a quick call with me to see how you can have the life you deserve. So go ahead and do that now, and I look forward to speaking with you real soon.